The arbitrage-free valuation model. In this reading, we'll talk about the meaning of arbitrage-free valuation, especially in the context of bond valuation. A central concept when we talk about arbitrage-free valuation is the binomial interest rate tree. We will learn how to create the interest rate tree, the binomial interest rate tree. We will look at how this tree is calibrated against market reference rates. And then we will use this model to value option-free bonds. Then we will move on to pathwise valuation because they are bonds that have options or bonds with embedded options where the value depends on the path of interest rates. So for this, we need a technique called pathwise valuation, and related to that is the Monte Carlo method. The final segment of this reading is about term structure models. So these are models that predict future interest rates. First, a simple definition of arbitrage. Arbitrage refers to a situation where we earn riskless profits without any net investment of money. Now, if there is an arbitrage opportunity in a well-functioning market, the prices will adjust very quickly until there are no arbitrage opportunities. So clearly, if a particular asset A is overpriced, then traders will sell this very quickly and the price will come down to the fair price. Arbitrage-free valuation refers to an approach to security valuation that determines security values that are consistent with the absence of arbitrage opportunities. This is a mouthful, but the definition has been taken from the curriculum and I think it's very appropriate. So in other words, our approach or our model is such that it comes up with prices that do not allow us to make arbitrage profits. The value of any financial asset is equal to the present value of its expected future cash flows. You have studied this in detail at level 1 and you have also seen this at level 2 in various topics. The link between this and arbitrage is that when an asset is valued using this method, where we look at expected future cash flows and then come up with the present value of those cash flows, then the number that we get or the value that we calculate is an arbitrage-free value. A related concept is the law of one price. Arbitrage opportunities arise as a result of violations of the law of one price. The law of one price states that two goods that are perfect substitutes must sell for the same price in the absence of transaction costs. We will now look at a more precise definition of arbitrage, and we will consider some scenarios where the law of one price is violated and this results in arbitrage opportunities. First, the more precise definition. An arbitrage opportunity is a transaction that involves no cash outlay yet results in a riskless profit. Now let's look at the first scenario. Asset A is a risk-free coupon bond that pays off $1 and is priced today at this number. Asset B is a portfolio of 105 units of asset A that pays off 105 1 year from today and is priced today at 95. This information is depicted here. Notice that we do have an arbitrage opportunity here. This sort of arbitrage opportunity is called value additivity, and it is because the portfolio, which is B, does not equal the sum of the parts. So how can a trader take advantage? Say at time t equal to 0, the trader sells 105 units of asset A and he will sell here for $100. So he makes $100 by selling 105 units of A, and then he buys asset B for 95. Net amount pocketed by the trader is +5. Then at t equal to 1, notice that both 105 units of A and bundle B produce the same cash flow. So if he had shorted A and needs to deliver at t equal to 1, how much does he need to deliver? He needs to deliver $1 times 105, which is 105. So this is how much he needs to pay at the end. And from B, he gets plus 105. So the net amount that he owes at the end is 0. So notice that without making any investment of his own, so no cash outlay, yet he earned a profit of 5. So in this case, the law of one price is being violated and there is an arbitrage profit. A trader would keep doing this until prices adjust and the arbitrage opportunity goes away. Now consider another type of arbitrage opportunity. Say we have two assets C and D which are both risk-free, and the pricing is as shown here. C is for 100 today and the payoff in 1 year is 105. So this represents a 5% return. D is priced at 200, payoff 1 year later is 220, and here the return is 10%. When we have two similar assets with different returns, then the type of opportunity or the type of arbitrage opportunity that arises is called dominance. And it is fairly obvious how we make money here. Let's say that we sell 2 units of C at a price of 200. So this is at time t equal to 0. Since we are selling C, we get $200, and those $200 are used to buy asset D. The net cash flow at time t equal to 0 is 0. Then at t equal to 1, notice what happens. Here, the 1 unit of D at t equal to 1 is going to give us 220, and since we had sold or shorted 2 units of asset C, the amount that needs to be delivered at t equal to 1 is 210. The net gain is 10. And here again, there was no cash outlay at t equal to 0, but we still have a profit. Now try example 1. So here is what needs to happen. We have bond A and we are told that this is a 3% coupon bond, 10-year annual pay, and we are told that the yield is 2.5%. The price is given. We simply need to come up with the price given these numbers, and if the price is equal to 104.376, then there is no arbitrage opportunity, and if the numbers are different, then there is an arbitrage opportunity. The curriculum uses the long-winded method of showing all the cash flows and then discounting each cash flow and then showing that the number actually equals 104.376. I will remind you that for something like this, you need to use the calculator. If the bond is a 3% coupon bond, it's 10-year annual pay, so N is equal to 10. The payment is equal to 3, so on $100 par value, it's an annual pay bond, so the yield is 3. The interest rate is equal to 2.5%, that's the yield. And what we need to also put in is the future value, which is 100, and you compute the present value, you will get this answer. So with bond A, there is no arbitrage opportunity. With bond B, you follow the same procedure and you will actually get a price which is different from this number, and that means that there is an arbitrage opportunity. When you do the calculations, the price that you should come up with is 98.311. So what are the implications of arbitrage-free valuation for fixed income securities? These are some fairly obvious points, but they are important. Using the arbitrage-free approach, any fixed income security should be thought of as a package or portfolio of zero coupon bonds. So in the bonds that we just talked about, if they were payments for 10 years, so 1, 2, 3, and then all the way to 10, there is a big cash flow at the end. Let's say the cash flow at the end is 103 and the cash flow at the end of each year is 3, then this bond really should be thought of as a portfolio of 10 zero coupon bonds. Given this, we can say that two bonds with the same maturity and different coupon rates are viewed as different packages of zero coupon bonds and valued accordingly. So if we have another bond where the coupon rate is 5%, then the coupon payments will be 555 and then 105 at the end. If this is a 10-year annual pay bond, this would be viewed as a different bond, and obviously the present values of each of these cash flows will be different. For bonds that are option free, an arbitrage free value is simply the present value of expected future values using the benchmark spot rates. And this is exactly what we did in the previous reading, where we came up with the spot rates and we would take each cash flow and discount at the appropriate spot rate. So the cash flow at the end of year 1 would be discounted at the 1-year spot rate, the cash flow at the end of year 2 would be discounted at the 2-year spot rate, and so on. The value that we come up with using this process is called the arbitrage free value. Arbitrage free valuation. Let's start with binomial interest rate trees. Here is a basic definition. An interest rate tree is a visual depiction of the possible values of interest rates, and more specifically forward rates, based on an interest rate model and an assumption about interest rate volatility. Now this is one type of an interest rate tree. This is a binomial interest rate tree. Notice with binomial, we are saying that from one particular interest rate, we can move to two possible interest rates. All the interest rates shown over here are one period rates. So I0 represents the current one period spot rate. This I1H represents the one period forward rate at time t equal to 1. The H represents the high value and the L represents the low value. The possible interest rates for any following period are consistent with the following three assumptions. Number one, an interest rate model that governs the random process of interest rates. So these future interest rates are based on a random process, but there is some structure associated with that random process. At our level, we will assume that the structure is provided by what is called a log normal model of interest rates. And let's understand what that means. With a log normal model of interest rates, adjacent interest rates on the tree are multiples of e to the power of 2 sigma. Sigma here is the volatility that we are assuming. And what exactly does this phrase mean? These are two possible interest rates. They are called adjacent interest rates, and the link between these two is as follows. Interest rate 1 comma h, this is the possible high value for the one period forward rate, is equal to I comma 1 comma L. So this is the low value into e to the power of 2 sigma. So according to the model that we'll be using, this is the link between two adjacent rates. Similarly, these two rates are adjacent, so they will also be linked with a similar formula. We can say that I2HL is a multiple of I2LL, and if we multiply this by e to the power of 2 sigma, we will get this. Similarly, if we multiply this by e to the power of 2 sigma, we will get I2HH. The advantage of this model is that interest rates cannot be negative. And that, you might recall from level 1, is a property of a log normal distribution. Also notice that if the volatility is high, so if sigma is high, then this expression becomes high, and the difference then between two adjacent terms becomes more. So that is intuitive. On the other hand, if the volatility is low, then the difference between adjacent terms is less. Coming now to the second assumption, there needs to be an assumed interest rate volatility. So as you see from the model that we are using, we need to assume a value for sigma. And in the examples that we'll do, we might assume a value of say 20% or 15%. So to create an interest rate tree such as this one, a certain sigma needs to be assumed. Also, we need to base this model on a particular benchmark yield curve. Only if a benchmark yield curve is given and known can we apply this model. Next, what is volatility and how is it estimated? The volatility that we are talking about is the sigma. This is the volatility of interest rates. With a simple log normal distribution, which is what we are using in this reading, the changes in interest rates are proportional to the level of the one period interest rates each period. The standard deviation of the 1 year rate is equal to I naught into sigma. So if I naught, the current interest rate, is 2%, and let's say that sigma is given as 10% or 0.1, then the standard deviation of the 1 year rate is 0.1 times 2%, which is 0.2%, or this is 20 basis points. In the context of this reading and on your exam, the interest rate volatility will be given. But in the real world, if you want to determine interest rate volatility, broadly speaking, there are two methods. One is the historical method, the other is the implied volatility method. The historical method says that the forecasted volatility or the expected volatility is based on the historical values. So we can look at the interest rates in the recent past and compute the volatility. Implied volatility, this looks at market data. So it looks at, for example, the current market price of interest rate options, and based on those market prices, the implied volatility of interest rates is determined. This is something that we will see in a little more detail in derivatives. We'll now learn how to calculate the value of a bond at a particular node. The process that we use is called backward induction. Here we start at maturity and fill in the value of the bond at maturity. Then we work backwards from right to left to find the bond's value at any particular node. Just as a very simple illustration, say this is the node that we are interested in, so we want to find the bond's value here. What we need to determine is the bond's value over here, assuming that the interest rate is high or the higher interest rate is realized. So the bond's value here, which is denoted as VH, plus any coupon payment. So this value is discounted back. And we also look at VL. This is the value of the bond if the lower rate is realized, plus any coupon payment. This is also discounted back, and then we take the average of these two numbers. So add them up, multiply by 0.5, and that gives us the bond value at a node. This concept is illustrated very well in example 3. So let's take a look at example 3 from the curriculum. We are given this interest rate tree. So at time 0, the 1 year spot rate is 2%. At time 1, the 1 year forward rate can either be 5% or 3%. So these are the two possible values 4 interest rates at this point in time. And then at time 2, there are 3 possible values for the 1-year interest rate. So notice that this is an interest rate tree, so all these numbers are 1 year or 1 period forward rates. We are valuing a 3-year annual pay bond with a coupon rate of 5%. So the cash flow is very simple. At the end of time 1, the coupon payment is 5. At the end of time 2, the coupon payment is 5. And at the end of time 3, the coupon payment is 105. And these numbers are shown in the tree. So what is the value of the bond at this node? We realize that the interest rate over here is 8%. So remember, we start at maturity and then work from right to left. At maturity, the cash flow is 105. With this node, the interest rate is 8%. So we discount back 105 at 8%. And if we are over here, then also we discount back at 8% because the rate associated with this node is 8%. And I've actually taken the calculations from the curriculum. So notice that at time 2 for the top node, we have 105 discounted at 8% and 105 discounted at 8% times 0.5. That will represent the value or the present value of these 2 possible payoffs. Actually, the payoff there is 105. So we literally have 105 divided by 1.08, and then you add 5, and that gives us 102.22. So the value here is 102.22. At this node, we have an interest rate of 6%, which is coming from here. And then we can say that 105 discounted at 6%, so 105 divided by 1.06 plus this coupon payment of 5, that will give us 104.06. I'm just rounding to 2 decimal places. And here at the bottom node, the interest rate is 4%, which is coming from here. We have 105 discounted at 4%, and then we add the coupon payment of 5. We get 105.96. Now we come to time 1. Here we take an interest rate of 5%, which is coming from here. So we discount 102.22 at 5%. We discount 104.06 at 5%. Both those values need to be averaged, and then we add 5 and we get 103.23. Using the same process here, we discount 104 at 3%. So here the 3% is the relevant number, and 105.96 also discounted at 3%. We find the average of those 2 values and add 5. That gives us 106.95, and the calculations are shown over here. So discounting at 5%, taking the average and adding the $5 coupon, and then this is for the lower node. And finally, we take these 2 values. So let's take 103.23 and we discount back now at 2%. This number is also discounted back at 2%, and then we find the average of the 2 and we get 103.0287. So this is the value of the bond using the backward induction process. We'll now look at how to construct the binomial interest rate tree. The interest rate tree is fit to the current yield curve by choosing interest rates that result in the benchmark bond value. By doing this, the bond value is arbitrage free. Let's say that our benchmark bond is the 2-year government bond. What we are saying here is that the interest rates that we show on the interest rate tree must be used to discount the cash flows associated with this bond, and the price that we get through this exercise, discounting the cash flows using interest rates shown on the tree, we must get the actual market price of this benchmark bond. And when we do that, we say that the bond value is arbitrage free, and the process of coming up with the set of interest rates that give us this arbitrage free value is called calibrating the interest rate tree. Let's look at how this process works. Step 1 is to determine the forward rates. Now, this is something we discussed in the previous reading. We will typically have the yield curve. This is the yield curve, let's say, for US government bonds. From the yield curve, we can determine the spot rates. From the spot rates, we can determine the forward rates. These are the forward rates which are implied by the current term structure. Once we have the forward rates, we can come up with a high and low value of interest rates based on a volatility assumption. Let's say that at time t equal to 0, our spot rate is 2%, and at t equal to 1, the implied forward rate given the current term structure is 3%. But when we are coming up with the binomial interest rate tree, we can't just have one number here. For t equals to 1, we need to have two possible numbers. One will be above 3%, the other needs to be below 3%. And if we assume a log normal distribution, which is what we talked about earlier, then we said that the two numbers need to be separated by a multiple. That multiple was e to the power of 2 sigma. So how can we make that happen? If we say that the medium value is 3%, then we can say that the low value is 3 times e to the power of minus sigma, and the higher value is 3 times e to the power of plus sigma. So then these two represent the two possible rates at t equal to 1, and we'll demonstrate this in the example on the next slide. And then we continue with the same process moving forward. So from here again there can be two further rates, and we use this process here also. We can then fork out into two possible rates. What we then do is check if the rates produced here result in the benchmark bond value. If they do, then we are done, because if these rates are yielding or giving us the benchmark bond value, then the model is arbitrage free. If not, then we need to make adjustments until we do get the benchmark bond value. And this overall process is called calibrating the interest rate tree. Example 4 will help us understand the process. Let's say that the 1-year par rate is 2%. So this is saying that we have a 1-year bond, and this bond has a coupon rate of 2%, and since there are no cash flows in between, so this 2% then also represents the spot rate at time t equal to 0. We are also given the 2-year par rate, the 3-year par rate, and from these par rates we can come up with the spot rates. And again, this is something we did in the last reading, so I will not repeat the process. We are also told that the price of a 1-year zero coupon bond is this. It is simply 1 divided by the 1-year spot rate, and P2 is this. This is the value at time 0 of a 2-year zero coupon bond with par value of 1, and this is P3. We are given an interest rate volatility assumption of 15%, and we need to calibrate the binomial tree shown below. Now the point is that this 2% is the current 1-year spot rate, so this obviously is true, but these rates are not right. If we discount, let's say, a bond with a par value of $1, if this is a zero coupon bond and we discount it back using these rates, we will not get this number. So some calibration is needed. So what's the first step? Remember, the first step from the previous slide was to come up with the current implied forward rates. So given these numbers, can we come up with the implied forward rate? Remember, this is something you did in the previous reading. So here is what we do. Remember, 3.015 is the 2-year spot rate. That's given right here. 1 plus the 2-year spot rate squared is equal to 1 plus the current 1-year spot rate of 2% plus 1 plus the forward rate. That's the forward rate over here at time t equal to 1. If we solve, we'll get 4.01%. This is the implied forward rate at time t equal to 1. But as I explained on the previous slide, we actually need two numbers, a high number and a low number for time t equal to 1, and we do that by using this calculation. The high number is 4.04 times e to the power of sigma. Sigma is our volatility assumption, which is 15% or 0.15, and the low number is 4.04 into e to the power of minus 0.15. Notice that the difference between these two then becomes e to the power of 2 sigma, or 2 times 0.15. We said that the high number is a multiple of the lower number, and the multiplier is this. So we get these two interest rates for time t equal to 1. We then use these rates to come up with the present value of a zero coupon bond with par value 1, and this is a 2-year zero coupon bond. According to the current term structure, the price of a 2-year bond should be 0.9423, and again this is based on $1 par value. So that is the market price given the current term structure. And when we use these numbers, we get something that is extremely close, 0.9419. Now, I can't imagine how you will be expected to do this on the exam, but in the real world, we can use a software tool such as Excel to come up with the exact interest rates such that we get the market price. And those exact rates are very similar to what we calculated, and these are the exact rates. From an exam perspective, as long as you know this conceptually, you are in good shape. In terms of calculations, you should be able to do steps 1, 2, and 3. For t equal to 2, we continue with the same process. The first step here is to calculate the implied forward rate given the current term structure, and that implied forward rate is this number, 6.167%. This becomes our middle value. Now, if that's the middle value, we need the high and the low values. Recall again that the difference between these terms is going to be e to the power of 2 sigma. So if this is the middle term, then the high value will be 6.167 into e to the power of plus 2 sigma, and the low value will be this into e to the power of minus 2 sigma. If we now use these interest rates to come up with the value of a 1-year zero coupon bond, a 2-year zero coupon bond, and a 3-year zero coupon bond, we will notice that we actually do get the correct market prices, and this implies that our interest rate tree is properly calibrated. Valuing an option-free bond. We will understand this concept through a simple example. Let's say that we have a 4-year bond, and this bond pays a 2% coupon, an annual coupon. The par value is $100. If that is the case, then the cash flow is shown right here. $2 at the end of year 1, 2 at the end of year 2, 2 at the end of year 3, and then 102 at the end of year 4. Let's also say that these are the spot rates. So the 1-year spot rate is 1%, and then these numbers represent the 2-year, 3-year, and 4-year spot rates. Using our simple arbitrage-free model, we can discount each cash flow at the appropriate spot rate and get this price. Now let's consider this binomial interest rate tree. And by the way, such a tree is also called a lattice, and you will see both terms used in the curriculum. Binomial interest rate tree is more common, but this can also be used. So we are given this interest rate lattice. Can we use this to come up with the value of the bond? The working is shown right here, and we will use the backward induction process. The cash flow at the end of year 4 is 102, and that is shown right here. So given this cash flow and given an interest rate of 2.834%, what is the value of the bond at time 3? So the value of the bond here obviously is based on the interest rate over here, and the value of the bond is this. Now, how do we come up with 101.1892? What we do is we take 102 and discount it. So 102 is discounted at this interest rate. 102 divided by 1.02834. That is the present value of 102. And then remember, at time 3, there is also a $2 coupon. So this discounted value plus $2 will give us 101.1892. Similarly, we can come up with this number. 101.9027 will be 102 discounted at this rate, 2.099, and then add the $2 coupon. That explains how you can come up with this time 3 column. And then for the time 2 column, we will use these rates. So 101.7639 is based on this value in the future and this particular rate. So in fact, you have to use both these values and this particular rate to come up with this price, and you will also need to consider the $2 coupon. To come up with this column, the time 2 column, we use information from the time 3 column as well as the rates over here. I'll just do one for you, and this is something you've seen before. To come up with this number, 101.7639, we take these two values and discount them at this rate, 1.786, and then we have to take the average, and then we add 2, which represents the $2 coupon here. So you can use the same process now to come up with all these other numbers, and working backwards, you will eventually get this price at time t equal to 0. And notice this is the same as what we got earlier. Now you can work through example 5 in the curriculum, which uses the exact same process. So here is example 5 presented for completeness. We are using the same information that we've seen before, and this example makes a reference to an earlier example, number 2, where we were finding the value of a 3-year bond, and the bond had a 5% coupon we were given the spot rates, or we were given the yields, the YTMs, and from the YTMs we could figure out the spot rates. We discounted the cash flows at the relevant spot rates and came up with this number. Then we are given this interest rate tree, which we calculated earlier, and using this particular interest rate tree and the various cash flows. So for a 3-year bond at time t equal to 3, the cash flow is 105, because at maturity we have par value plus the final coupon, and then this value over here, 102.0721, is based on discounting 105 at 8.167%, that's this rate, and then adding the $5 coupon. And we use the same process to come up with the other numbers, and as we showed on the previous slide, to come up with this number, the 4.646 rate, as well as these values. When we work all the way back to time t equal to 0, we get the same answer that we got over here. Pathwise valuation. So this is another way of coming up with the value of a bond. Pathwise valuation calculates the present value of a bond for each possible interest rate path and takes the average of these values across paths. In other words, what we need to do is the following. We have to specify all of the potential paths through the tree, and then for each path we determine the present value of a bond along that path, and then we calculate the average across all possible paths. If we consider a 3-year zero coupon bond and we say that interest rates can take one of 4 paths, we list each path and then show the rates for each path. So the current spot rate, let's say, is 1%. Then the 1-year rate after 1 year is this, and the 1-year rate after that is 1.7663%. Then what's the present value of a zero coupon bond with par value of 100? So here is what we do. If the par value is 100 at the end of year 3, then we can discount back using these rates. So we would have 100 divided by 1.01766, so that's this number, and then this is discounted using this rate, so 1.0161, and then again further discounted at 1%, so divided by 1.01. When we do this discounting, we will get this present value. Similarly, we come up with a present value for the other paths, and then this number represents an average of the present value from all 4 paths. Example 5 again demonstrates what we are talking about, and this is a continuation of the earlier examples. The numbers are the same, and if you recall, we were talking about a 5% coupon bond, and the cash flow for that bond is basically $5 at the end of time 1, $5 at the end of time 2, and 105 at the end of time 3. And in this particular case, the cash flow is not path dependent, so regardless of the path, the cash flow is always the same. Then for every path, we know the forward rates or the relevant interest rates. We take the cash flows and the relevant interest rates and come up with the present value at time 0 for each path. Here there are 8 paths, and then we come up with the average of these 8 numbers. And finally, we come to the Monte Carlo method. Monte Carlo methods are often used when a security's cash flows are path dependent. This will be discussed in more detail in the next reading, but just to give you a very simple idea, certain securities, such as mortgage-backed securities, are path dependent. In other words, the value of a mortgage-backed security at a particular point in time depends on the interest rates at that point in time, plus the path that interest rates have taken to get here. And this is something that we'll discuss in more detail later. But clearly, when the path matters, then the method that is used most often is the Monte Carlo method. From a testability perspective, recognize that the backward induction method that we talked about would not work for a mortgage-backed security or any security where the price is path dependent. What I'll now do is just list some of the points related to the Monte Carlo method which I think are most important. There isn't too much stated in the curriculum. This is a short segment, so I feel that as long as you understand the points that I'm making here, you are in good shape. The Monte Carlo method involves randomly selecting paths in an effort to approximate the results of a complete pathwise valuation. In the earlier segment, we talked about pathwise valuation where there were maybe 4 paths or 8 paths. But what if there are thousands, if not millions of paths? Then what do we do? What the Monte Carlo simulation method does is selects a representative set of paths. Let's say that we intend to value a 30-year bond with the Monte Carlo method, and typically these bonds have monthly payments, so each period will be 1 month. And the steps that we use are as follows. First, we simulate numerous paths of 1 month interest rates under some volatility assumption. So notice that in this particular example, we are using 500 paths. Say that if we were to consider all paths, there would be 10,000 paths, which might be very hard to work with. So we have our computer select a representative set of 500 paths. Then we generate spot rates, or actually the computer generates spot rates from the simulated future 1 month interest rates. Then the system determines the cash flow along each interest rate path. Then it calculates the present value of each path. And finally, the system calculates the average present value across all interest rate paths. So in simple terms, this is the process. Now let's say that this method is used and we come up with a value for a benchmark security which is different from the market price. And that typically is what will happen. It's extremely unlikely that you use this method and come up with a number that exactly matches the market price. So some work needs to be done to make the price generated by the method or the model equate the market price. That is done by adding a constant to all interest rates on all paths such that the average present value for each benchmark bond equals its market value. This would be similar to calibrating the interest rate tree. The constant added to all short interest rates is called a drift term. When this technique is used, the model is said to be drift adjusted. Notice that here we are talking about selecting a representative set of paths, but obviously for each path there is a certain model that is being used to calculate the value. So the method is only as good as the model being used, and the inputs obviously are different interest rates. The quality of the method or the model clearly also depends on the inputs. When analysts use the Monte Carlo method, they consider the fact that interest rates are mean reverting. The way this is used in the model is by giving the interest rates certain low and high bounds. So recognizing the fact that interest rates will probably not go above a certain level and probably not go below a certain level, there are constraints put on the system that say that interest rates must remain within a certain range. So these are the major points that I feel you need to know related to Monte Carlo. The curriculum presents example 7, which I think is extremely straightforward. All it does is shows a representative set of paths, calculates the present value for each path, and then shows the average of those present values. So it is more or less like the pathwise method that we saw earlier. We now come to the final section of this reading, which is term structure models. term structure models try to explain the term structure of interest rates. So therefore, term structure models provide quantitative descriptions of how interest rates evolve, and because of this, they seek to explain the shape of the yield curve. So for example, if the yield curve looks like this, what the model will try to explain is how rates are evolving and why interest rates in the future are higher than the rates today. Since fixed income securities depend heavily on interest rates, the future cash flows depend on projected future interest rates, the discounting depends on interest rates. Therefore, term structure models can be used to value bonds and bond-related derivatives. There are 4 subsections. In this first subsection, we will talk about term structure models at a high level. Then we'll get into the major types of term structure models, equilibrium models and arbitrage-free models. And then there is a brief segment on modern models, which build on the equilibrium models and arbitrage-free models. So let's talk about model choice. Term structure models make simplifying assumptions about how interest rates evolve. There are many different interest rate models and they have different assumptions. So what differentiates models is the sorts of assumptions that are made. No single model captures interest rate dynamics perfectly, and in general there is a major trade-off. The trade-off is between simplicity and accuracy. Term structure models describe interest rate dynamics using stochastic processes. Stochastic processes are processes that involve uncertainty or randomness. Interest rate movements have 2 components. One is a drift term and the other is an uncertain or stochastic term. So this is where the randomness is coming from. The general form of a one-factor model looks like this. So the change in interest rate would be something times a small change in time. And here this theta will depend on the model. On the next couple of slides, we look at different models and you'll see different variables showing up here. And then this is the uncertain or stochastic term. Z is a random variable which is normally distributed. And again, in different models, this random or stochastic term will vary. There are 2 major types of models: equilibrium term structure models and arbitrage-free models. Equilibrium term structure models describe the dynamics of the term structure using fundamental economic variables that are assumed to affect interest rates. So these models rely on actual economic variables. In arbitrage-free models, the analysis begins with the observed market prices of a reference set of financial instruments, and the underlying assumption is that the reference set is correctly priced. So these arbitrage-free models are based on actual market prices. Let's now talk about equilibrium models in a little more detail. As I've said before, equilibrium term structure models describe the dynamics of the term structure using fundamental economic variables that are assumed to affect interest rates. The major characteristics of equilibrium term structure models are shown here. These models can be one-factor models or multi-factor models. They make assumptions about the behavior of factors, and these models have relatively few parameters that must be estimated relative to arbitrage-free term structure models. And this means that equilibrium models tend to be simpler than arbitrage-free term structure models. The 2 best-known equilibrium models are, number 1, the Cox-Ingersoll-Ross model, which is generally called the CIR model. And this is the term that you should remember. So under equilibrium models, we have the CIR model and the Vasicek model. You need to remember these 2 names and you need to know a little bit about each of these models. The first thing you need to know that these are both equilibrium models. The second thing you need to know is that both these models assume a single factor which is the short-term interest rate. Now let's talk about the CIR model. According to this model, interest rates are mean reverting and volatility increases as rates increase. This is the formula for the CIR model. So this is the change in rate, and this depends on the drift term and the stochastic term. In the drift term, we have the factor which is short-term interest rates, but we also have theta and k. Theta is the long-term interest rate. Remember, we said that this is mean reverting. When a variable is mean reverting, we need to know what the mean is. So that mean is given by theta. If the short-term interest rate is above theta, then that interest rate will move down or drift down towards the mean. And the rate at which this drift happens is controlled by k. The larger the k, the faster this drift towards the mean. Obviously, if r is below the mean, so if the current short-term interest rate is below the long-term mean, then the rate will drift upwards. So this is the drift term. Then we have the stochastic term. And with the stochastic term, note that we also have the short-term interest rate here. And what this means is that if the short-term interest rate is high, then the variability will also be high, because if r is high, then this overall term will be high. And if r becomes small, then this term also becomes small. The other point to keep in mind, as I said before, is that z is a random variable which is normally distributed. So this can take on a negative value, but when r is small, so as interest rates become small, this term becomes very small. And since this term is very small, therefore, in this model, overall, the interest rates can't be negative. The other equilibrium model is the Vasicek model. This has the same drift term as the CIR model. So with Vasicek, notice the drift term is the same. But unlike the CIR model, the interest rates are calculated assuming that volatility remains constant over the period of analysis. So over here, we do not have a dependence on the short-term rate. Notice that with CIR, we have the short-term rate, but here we don't have a short-term rate, which means that if the interest rates are relatively high, there is a certain volatility. If the interest rates are low, we also have a certain volatility. This volatility or stochastic term does not depend on the level of interest rates. And because of this, it is possible that the rate that's predicted is negative. So in this model, it is possible to have negative interest rates in the term structure. Moving on to arbitrage-free models. In arbitrage-free models, the analysis begins with the observed market prices of a reference set of financial instruments, and the underlying assumption is that the reference set is correctly priced. The reference set might be the government yield curve, for example. The arbitrage-free models are calibrated to the current term structure. And as I said, this term structure would be for the reference rate, and the reference rate could be government rates over different maturities. Arbitrage-free models are frequently used to value bonds with embedded options. So the point is that the models are determined based on market rates, and then once the model has been obtained, that model is used to value more complicated bonds, such as bonds with embedded options. Under the arbitrage-free category, we have two important models that you need to be aware of. One is the Ho-Lee model, and the other is the Calote-Williams-Fabozzi model, or the KWF model. The Ho-Lee model is calibrated to market data by calculating the time-dependent drift term, which is theta t, from market prices. So these models, the Ho-Lee model, and as you will see shortly, the KWF model, have a time-dependent drift term, and this is calculated based on market prices, and that's where calibration against market data comes in. The value for this time-dependent drift term, theta t, at each time step is calculated so that the model produces prices that match market prices. And this is the formula. So we have the short-term interest rate, and that is based on this time-dependent drift term. And we know it's time-dependent because we have a small t here and dt. So this theta t is the time-dependent drift term. And then this is the volatility term. Z is the same random variable that we've talked about before, which is normally distributed, and sigma is volatility. So notice that here the volatility is not rate dependent. Whether the rate is high or low, that doesn't impact volatility. The other model is the KWF model. This is similar to the Holy model in the sense that it assumes constant drift. So that's the drift term, no mean reversion, and constant volatility. So this point applies to both the Holy model and the KWF model. Again, constant drift term, no mean reversion, and constant volatility. The difference between KWF and Holy is that with KWF, we use the natural log of the short rate. So that is what the equation is predicting. It's giving us the natural log of the short rate, which means that the natural log will be normally distributed and the short rate itself will have a log normal distribution. Since the short rate has a log normal distribution, that helps ensure that with this model, the KWF model, we cannot have negative interest rates. So I'll give you a silly statement that will help you remember the fact that these are arbitrage-free models. So remember this. The Holy Koala Welfare Fund is arbitrage-free. So the Holy Koala Welfare Fund is arbitrage-free. Now, obviously, this statement makes no sense, but I'm sure you will remember it. The Holy Koala Welfare Fund is arbitrage-free. So this way you will remember that the Holy model and the KWF model is arbitrage-free. Remembering Koala Welfare Fund is much easier than remembering Calote Williams Fabosi. And also on the exam, this will most likely be referred to as KWF. So you now know that the Holy model and the KWF model is arbitrage-free, which means that these are two arbitrage-free models. And to further hammer in the point, here is an exhibit from the curriculum that shows you the 4 different models we've talked about. These are the 2 equilibrium models, CIR and Vasicek. In both these models, we have a single factor, which is the short-term interest rate. We have mean reversion, and the mean reversion speed is K. The difference between these 2 models, or the major difference, is that with Vasicek, the volatility is constant, and it is possible that this model predicts a negative interest rate. With the CIR model, the volatility varies with the square root of the short rate, which means that when the short rate comes down, the volatility also comes down, and hence with this model, it's not possible to have a negative interest rate. The Holy and the KWF are the 2 arbitrage-free models. With Holy, the short-term interest rate is the factor, whereas with KWF, we use the natural log of the short rate. The drift term is time-dependent and the volatility is constant. Coming now to the final segment, which is modern models. Modern interest rate models build on the one-factor equilibrium and arbitrage-free models that we've discussed on the previous slides. Some modern models extend one-factor models to include multiple factors. So the major factor that is often used is the short-term interest rate, but other factors can also be included. There are some modern models that use sophisticated approaches that combine observed forward curves with volatilities extracted from interest rate option prices. So with interest rate options, there is an implied volatility, and these sophisticated approaches try to use that implied volatility. An example of a modern model is the Gauss plus model, which takes into account short-term, medium-term, and long-term interest rates. In this model, long-term and medium-term rates are mean reverting, whereas short-term rates are controlled by central banks. So this is sophisticated and recognizes some of the nuances associated with shorter-term rates and longer-term rates. It also assumes that the volatility curve is hump-shaped, with medium-term rates being more volatile. Now, there are some questions which have been taken from the curriculum that are very important from an exam perspective, and I want you to do this. So the first question is, which of the following would be expected to provide the most accurate modeling with respect to observed term data? Now, you might have forgotten which model does what or the assumptions behind the different models, but I hope you remember the silly statement that I told you. And I also hope that you remember that with arbitrage-free models, the models are calibrated based on the observed term structure. So the answer to this question should be a model which is an arbitrage-free model. And the silly statement will help you figure out which is that model. And the silly statement was, the Holy Koala Welfare Fund is arbitrage-free. So we will either have the Holy model or the KWF model. And over here you can see that we have Holy, CIR and Vasicek are equilibrium models. So here the best answer would be B. Second question, which of the following statements about the Vasicek model is most accurate? Now remember, Vasicek is an equilibrium model. It has a single factor, the long rate. It has a single factor, the short rate. It has two factors, the short rate and the long rate. I hope you can also remember that with all four models that we discussed, there is a single factor, and that factor is the short rate. So this is quite easy. And then the CIR model assumes interest rates are not mean reverting, has a drift term that differs from the Vasicek model, assumes that interest rate volatility increases with increase in the level of interest rates. So I hope you remember that with both the equilibrium models, the assumption is that interest rates are mean reverting, but this option says not mean reverting, so it's not correct. Has a drift term that differs from that of the Vasicek. Actually, with both the equilibrium models that we've studied, CIR and Vasicek, the drift term is the same. Therefore, this is not correct. And then by elimination, you know that this is right, but I'd like to take you one step further. Some students will forget which model is the one where volatility increases with the level of interest rates. So we have CIR and then we have the Vasicek, V-A-S-I-C-E-K. So notice there is an R over here. And based on this, you can remember that with the CIR model, volatility increases with the interest rate. For the Vasicek model, the volatility does not change with R, and there is no R over here. Again, that's a silly way of remembering, but with CIR, we have volatility being dependent on the level of interest rate. So the best answer is C. Please also read these answers from the curriculum, which give you a more theoretical answer, and obviously you need to be aware of what the curriculum is saying. We have now come to the end of this reading. Let's summarize the key points. An arbitrage opportunity is a transaction that involves profit without taking any risk. So for example, if somebody can make money without investing anything, that would be an arbitrage opportunity. Arbitrage-free valuation means coming up with a value such that there is no arbitrage opportunity. For bonds that are option-free, an arbitrage-free value is the present value of expected future values or expected future cash flows, which are discounted using benchmark spot rates. We talked about binomial interest rate trees. An interest rate tree is a visual representation of the possible values of interest rates or forward rates based on an interest rate model and an assumption about interest rate volatility. In binomial interest rate trees, the interest rate in the next period has an equal probability of taking two values. So from a given value, we can then have two values in the future. Each of these values has an equal probability. Interest rates cannot be negative. The adjacent interest rates on the same tree are multiples of e to the power of 2 sigma, where this is the volatility. And as rates become higher, the volatility also becomes higher. We talked about pathwise valuation. Pathwise valuation calculates the present value of a bond for each possible interest rate path and takes the average of these values across paths. We discussed the Monte Carlo method. Monte Carlo methods are often used when a security's cash flows are path dependent. The Monte Carlo method involves randomly selecting paths in an effort to approximate the results of a complete pathwise valuation. The final segment of this reading had to do with term structure models. And here there are 4 important term structure models that you need to remember. The CIR and Vasicek, which are equilibrium models, and then Ho, Lee, and KWF, which are arbitrage-free models. So that is it for this reading. As always, I want you to go over the questions in the curriculum, do the examples on your own if you have time. Definitely do the practice problems and also do all the IFT questions.